In this video, I'm going to take two approaches. First, I'm going to begin with custody, and then I'm going to move on to the approach of non-custody, making the assumption that you're somebody new getting into crypto. What is the factors of taking one road versus taking the other road? What are the pros and cons and different things to consider? So first, we're going to tackle custody. So custody situation is when you don't actually hold your, let's say, Bitcoin or whatever other coin it is. Somebody else is actually holding that on your behalf. Most of the time, that's an exchange. So let's say, for example, you're using an exchange like Coinbase. So you make an account, then you're able to connect your bank account and you move funds onto Coinbase. You're able to buy and sell. Coinbase is going to keep records of this. They record each transaction that's taken place. Then, after that's happened, we have to consider what comes next. How does using this custodial approach impact our taxes and how we would record taxes? In a custodial approach where you've used, let's say, just one exchange, Coinbase, at the end of the year, you would take the data from Coinbase, and that would be the record of all your transactions. Now, if you were to include a bunch of other exchanges, then you would also need to pull all the records from those different exchanges, connect the records together so that it was able to prove that you moved money from exchange A to exchange B. Maybe you moved it back again. Maybe you sold some back to your bank account. These different transactions that impact the cost of how much you paid and how much you sold for, these things all need to get recorded. In this custodial situation, we have something called CeFi that you would also consider. So there's platforms that are custodial that will offer you interest-bearing accounts. So interest-bearing account generally means that they are taking your funds and they are lending them out to someone else, or they're using it some other way on their platform, depending on the platform, to derive profits. In most cases, not really different than how your bank would. Well, they derive these profits from your money, they pay you back as a reward. So that reward comes in the form of interest. Sometimes these interest rates can be 5%, 8%, or even 1%. It kind of depends on how much value they can derive from your funds. Something else to consider in the custodial situation is access to education. So while you're on the custodial platforms, as a new person, you do need to be careful what exchange you use, because exchanges in the past have lost all of people's funds. So this is a risk that you are incurring, but also at the same time, these exchanges do offer a variety of educational things that you can do. They may offer videos about how blockchain works. You can watch these videos. They may offer videos about specific coins on their platform. You can also watch those. And in some cases, they actually will pay you to learn and do a test about that specific project. You are, however, most likely missing out on the opportunity of most of what you would learn physically using a blockchain. So you're not getting this practical experience of actually using the technology. You are kind of just a bystander on the side of the technology. The risk of that is that you're buying and selling things that you can't really fundamentally understand because you've never used them. Now let's cover non-custodial. When we look at non-custodial, we have some really obvious risks. Some of those risks are that nobody else is responsible for your funds. You are, because you personally are holding your funds. Those funds can be stolen, those funds can be hacked. It all depends on your level of knowledge of how you're storing those, how you're keeping them safe. What are the methodologies that you're using? What level of online awareness do you have? One of the factors to consider is when we look at a traditional system. For example, you may use more a hybrid system. You may use custodial and non-custodial. For example, many people back when we were using cash, which operates very similarly to cryptocurrency, except for cryptocurrency is basically a digital form of cash. Cash is a transaction between two parties with no intermediary. Bitcoin is doing the same thing. You're creating a peer-to-peer transaction between two people with no intermediary. An option to consider while you're doing this is a hybrid between non-custodial and custodial. What would that look like? So in a bank situation, traditionally most people have most of their money in the bank, and then they had some cash in their wallet. The reason that they had cash in their wallet is that was the money they were going to spend. So if they have a small portion of their money in their wallet and their wallet gets stolen, they're not necessarily super worried because most of their money is in the bank. Though it may be painful, it's not as detrimental as losing everything. What are the tax implications of this? Well, the tax implications could become quite sophisticated when you start playing with the blockchain space. You may need to record various types of transactions that you may need to know how to use block explorers to pull from. You'll need to know how to actually look up your transactions and record them, and what various different softwares you could use to also record those transactions. Some will do it automatically for you, pulling a lot of this data for you. Some of them are going to be much more manual. This is something that you're going to have to learn about. This is one of the advantages and disadvantages. It kind of forces you to learn more, become educated, become a knowledgeable participant versus just a bystander. But at the same time, you expose yourself to some risks that you didn't have the same risks in the custodial side. Another thing to consider on the non-custodial side is lending and interest. What are the implications of this? Because we're dealing with software, what happens is we can have all sorts of different programmed ways to earn money. This comes in various forms, some more complicated than others. The most basic of them being deposit your money and earn interest. Another application in the same situation is take that deposited money and make an over-collateralized loan against it, where you're getting an interest rate that's derived from the crypto market. So you have both people depositing their money and people collecting an interest rate. That's how you are getting your rate, is the more people who deposit their money for a certain interest rate and the less demand there is for a loan, that's how the interest rate is built. You also have what's called LP, or liquidity provider. So you might have, let's say, Bitcoin and a US dollar stablecoin, and they're trading against each other. But how do you get them to trade against each other without an exchange? Well, you do that by having somebody provide either a bunch of Bitcoin or a bunch of that stablecoin. And by having money on both sides, a person can come in and trade theirs for the opposite one, the one that they want to get, because that money's already sitting there. By providing money to facilitate these trades, people also make money. On top of that, there's other mechanisms that are emerging constantly. Insurance-based earnings, where people are providing insurance to other people, and if a smart contract gets hacked, then they have to pay out that insurance. If the smart contract doesn't get hacked, then the insurer makes a rate similar to what an insurance company would make, insuring whatever they're insuring. All these things are getting built on top of the blockchain. Really, the only way to use them is to use them directly through a non-custodial wallet and learning how to actually engage with the blockchain. These educational pieces become quite complicated to learn and understand, though they allow you to access knowledge that very few people actually have. Lastly, for covering these transactions that are done through a non-custodial situation, let's cover a few different things. How you would store your private key mnemonic phrase. I covered other videos to talk about what those are. How are you going to store that? Because you're physically storing the key that unlocks your money. You need a methodology to store that. So these methodologies are various. We have browser extension wallets, we have mobile wallets, we have what are called paper wallets, we have what's called hardware wallets. All of these are going to vary depending on your use case. I can cover some of these in future videos if you're interested, but you're going to need to understand the differences between these things while you're making these informed decisions and using the blockchain. And I'm going to cover a third option, brokerage accounts. So sometimes brokerage accounts will actually allow you to either buy into funds, or in some cases, like Canada, you can actually buy, for example, a Bitcoin ETF. In that situation, you wouldn't be able to access most coins. You would only be limited to very few coins. Your brokerage would actually do your tax reporting. They give you the same documents that they would do for the rest of your stocks. You would give that to an accountant and they would do the correct paperwork. This would look very similar to the paperwork that they would normally receive, and wouldn't lead to a situation where your accountant doesn't know how to do crypto bookkeeping or accounting, which could be very concerning when that a moment arises. Though this is the simplest approach, you run into a situation where in some of these cases, these funds could potentially be lost, the business could go out of business. Sometimes the assets are not separated from the actual business that's doing it, so they're not held in your name, they're held in the business's name. So if the business went bankrupt, you lose all your money. There's different factors to consider in that environment to outlie risks outside of what's found in you just holding the asset. You're taking on additional risks, though at the same time you're simplifying your tax side obligations. As you can see through this video, we've covered various different options. There's a lot to think about, a lot to consider. Please don't forget to like the video and subscribe. I'd like to see you again. Have a great day.